Good evening, everyone. It's a very cool evening today. Thank you for joining the Corporate Connect featuring First REIT, as well as our audience from Facebook Live. This online webinar is organized by SIAS and supported by SGX. We will kick off today's webinar with a presentation by Ms. Amelia Tan, research analyst from SGX on recent market highlights, followed by the corporate presentation by Mr. Victor Tan, Chief Executive Officer of First REIT. We will then end off with a Q&A session. First REIT is Singapore's first healthcare real estate investment trust, listed on 11 December 2006. Under its belt, First REIT built 32 high-quality and diversified asset portfolio, comprising 15 located in Indonesia, 3 in Singapore, and 14 in Japan. Managed by First REIT Management Limited, which is 60% owned by OUE Limited and 40% owned by OUE Lippo Healthcare Limited. Without further ado, can I invite Amelia to present? Over to you, Amelia.
Hi, everyone. I'm going to be sharing my screen. So today we'll talk a little bit about some of the market highlights for the year to date. I thought it would be good to do a year-end wrap since we've already closed out November, we're already into first week of December. We'll take a look at how our markets have performed over the last few years, and then we'll zoom a little bit into the REIT sector. Then, of course, we'll be very excited, myself even, to hear what First REIT has to share with us today. Okay, so moving on. Okay, STI has gained about close to 7% in the last month in November, and that in fact has brought our year-to-date total returns to about 10% this year. November was an interesting month because that month saw a lot of the other markets significantly also have rebound in terms of the price gains. And in fact, for STI, it was one of the strongest price performance for the index since March 2021. Of course, a few things that were drivers for this piece. I think if everyone recalled last week when the Fed announced or sort of indicated that there would be a potential deceleration in terms of the interest rate hikes towards the end of this year, that helped to sort of spike a bit of the investor interest and also relief, right, as investors look to the markets for the year end. And then also a few things would be in terms of, for example, Asia's growth for 2023 and 2024. I believe in some of the reports that we've seen in the analyst space they've put out would be Asia would be one of the key growth markets within the global region for the next 2 years, and will be one of the key drivers in terms of the growth. And not just that, in terms of China, the COVID policy, and they've also indicated a potential opening for early next year. That has also helped to sort of gain some of the investors' interest for the markets, and which is why you've seen global markets, not just Singapore. Last week, it has Asian markets have also somewhat rebounded, and we've closed out November pretty strongly, bringing our year-to-date returns at 10% on a year-to-date basis. And on a year-to-date basis at 10%, I think we are, in fact, probably one of the best performing indices on a year-to-date return basis. If we look at the FTSE Asia Pacific, it was, I think, generated a decline of about 15%. Comparatively, the FTSE developed markets have also returned a decline of about 13% on a year-to-date basis. Now, we took a look at our stocks in the Singapore market, especially the 100 most actively traded stocks on a year-to-date basis. Their returns have also mirrored what our STI has performed. The 100 most actively traded stocks return about 10%. And in fact, we have seen about over 712 million worth of net fund flows from institutional investors into these 100 stocks in the month of November. On a sector landscape, right, you see the chart on the right-hand side. Banks, consumer, telecommunications, these were the sectors that led the inflows in the month of November, whereas on the other hand, REITs, healthcare, energy were some of the ones that booked the most net fund outflows. Okay, and on a year-to-date basis, it also has somewhat mirrored telecommunications, banks, consumer sectors. These have also led the way, led fund flow, net institutional fund flows for the past 11 months. Now, today I want to talk a little bit about REITs because it's a very special session today where we have First REIT, Victor, that will be talking to us and sharing a little bit more about some of the developments over there. Won't steal his thunder, but there's a very interesting story behind First REIT. They've got the 2.0 growth strategy. They've also started venturing into new markets with the acquisitions into Japan. There's a growth story over there, and we'll be keen to sort of hear a little bit more. But before that, just to recap and to let everybody have a bit of a rehash on the Singapore REITs market, would be Singapore, we have about 42 REITs and property trusts that's listed on the exchange. Comparatively, within the context of Asia outside of Japan, we are one of the largest S-REITs market in this space. We've got 42 REITs and property trusts with a combined market cap of close to 100 billion. So what this means is if we look at the 100 billion market cap against our full Singapore stock market, it represents about 12% in terms of the total market capitalization. But in terms of average daily volume and value traded, it's actually around a quarter, in fact, a bit more of a quarter. So that means to say that every day, the amount of volume and value traded on the exchange, about a quarter goes to trading in REITs. And for REITs, the average dividend yield, generally REITs are seen as an income stock, okay, because they have regular dividend payouts, and our average dividend yield across our 40 plus REITs is about 7.7%. And in terms of valuation, the S-REITs on an average basis are trading at about 0.8 times price to book. And if you see the top right-hand corner, the two pie charts, wanted to bring your attention to that, right? To talk about that in terms of the sub-segment or sub-sector diversity. So within our S-REIT space, it's very well diversified. We've got up to, I think over here, 7 sub-segments ranging from industrial, hospitality, all the way down to specialized REITs like data centers, and even some of these REITs with healthcare assets. The pie chart on the left shows that in our Singapore REIT market, we've got over 40 REITs, but over 90% of these REITs actually have overseas assets. So Singapore's REIT market isn't just about domestic assets. When you buy into a REIT and you invest into REITs, you're not just investing into Singapore commercial properties, but you're also having the exposure where the REITs have overseas portfolio, overseas assets in the different geographies and the different industry segments. You can then have exposure through these REITs. Okay, and over here at the bottom right, these are some of the trusts that have pan-Asian exposure. This is a slide that I have taken from our monthly REIT chart book that is available on our website. So for investors that's keen to keep track of our REITs on a monthly basis, you can get these slides and this deck available on our website. Now, this slide shows a correlation matrix, and I think I wanted to show this just to highlight to everyone that REIT as an asset class is a unique one. It, in a way, behaves a little bit like fixed income, where there's regular dividend payouts, but it trades like an equity, like a stock. And in this case, if we look at the correlation matrix over the past few years, you'll find that it's really a unique asset class that has a relatively low correlation against some of the other asset classes. So it's a good sort of instrument to consider if you're looking at diversifying and building your portfolio over here. Now, this slide will be interesting when it comes to looking at yields. Okay, the average dividend yield that our S-REITs and property trusts distribute on an annual basis would be around 7% or so, and that compares with our STI index, which generates around 4%. And of course, that compares to putting our money into the bank or fixed deposit or government bonds and against the core inflation rates. And I think most of us that are generally sort of keeping tabs against the local residential price market, you find that investing into residential property, for instance, right, the yield generally would be perhaps ranging around 2+ to 4%. Comparatively, REITs provide investors with exposure into commercial properties such as shopping malls, office assets, industrial logistics, warehouses, etc. And the yield is also, as you've seen historically, generally is a bit higher than the residential yield. And also what we would sort of say this to investors is that unlike buying a residential property where you need to have down payment, which is a fairly large quantum, buying REITs is similar to buying a stock. So it means in terms of fractionalization, right? You can buy in terms of how many units. In terms of the quantum wise, when you invest into REITs, you can start off with even as little as 100 shares per lot size. So probably also more in terms of the bite size, right? More palatable in terms of the quantum amounts when you're starting to look into investing into REITs versus buying a physical shopping mall or industrial space. Now, this slide, just historically, just to give everybody a sense, this is a chart that we've taken from our REIT chart book. The chart on the left shows the yield spread today, which is generally around 300 basis points, below the historical average of about 384 basis points. Chart on the right shows the S-REIT index. In this case, I believe it is the FTSE ST REIT index that we've looked at, having a look at the price to book and also the dividend yield on a longer term basis. Price to book of the index is generally around 0.88 times, which is below the 10-year average of about 1.04 times. Dividend yield of the index is generally around 4.1 to 4.2%. This slide is just to show a breakdown when we talk about the average dividend yield across the sector being at 7.7%, how it looks like within each of the subsegments. So in this case, you can see some of the subsegments that have a higher average 12-month trailing dividend yield would be office REITs, followed by retail and diversified. Okay, for this slide, I'll spend a little bit more time talking about that. And I just wanted to give everybody sort of an update in terms of where we are today with the market and also where our REITs are. If we look at the global REIT indices, not just the Singapore REIT index, generally, yes, 2022 has been a challenging year for the sector given some of the macro environment, and also there's been rising interest rates, right? But regardless of those factors, our REIT on a year-to-date basis has generated a decline of about 11%. And this is also somewhat more resilient versus some of the other global REIT markets looking at this chart. November 2022, we talked about it earlier on. It's a better month because there were some of the key drivers that were driving the market. We've seen our S-REITs also rebound quite significantly, in fact, 6% in November. And this has also comparatively outperformed some of the regional global REIT indices, especially the benchmark REIT index. In this case, we took a look at the FTSE EPRA REIT Developed Index. And I talked about this earlier on, right? What were some of the factors that were driving this, which is the interest rates, the expectation that December's rate hike wouldn't be as large as before, potentially indicating some sort of like a slower pace in terms of the interest rate hikes, and also the economic growth expectations in Asia market in general. And of course, not forgetting the opening theme that has been a theme that has been driving some of the markets over the past few months. And in fact, I wanted to also highlight a little bit of some of the recent updates that our REITs have announced in their business updates or quarterly earnings that they've shared, indicating some sort of like a green shoots within this space. Okay, this slide shows a summary of how our S-REITs within the individual subsegments have performed on a year-to-date basis. You can see the bar charts in green. That is the total returns for the month of November. So what I mentioned earlier on, right, the reopening theme, we can see that happening in some of these subsectors like hospitality, retail, even in diversified REITs and also specialized REITs. And on a year-to-date basis, hospitality REITs have also been somewhat the more resilient ones. And in fact, during the month of November, we noticed that retail investors continue to pick up REITs and also put them in their portfolio because they've been a key driver of the sector's fund flow activities, accumulating, I think we've seen about over 54 million in terms of the net retail fund flows into this particular sector. And what retail was buying in the month of November, they were buying office REITs, industrial REITs, and also healthcare REITs. This slide would be drawing out some of the highlights that some of these REITs that have reported their third quarter financials or business updates, highlighting some of the green shoots that we're seeing, despite on a year-to-date basis, REITs in terms of the price returns still on a decline, but we're still more resilient versus other global REIT markets. But nonetheless, putting aside price returns, price gains. Fundamentally, right, looking at how these REITs have started to report some of the operating metrics, we're seeing green shoots in some of them. For instance, in hospitality, in the last round of quarterly updates, business updates, all of the hospitality REITs in Singapore, those with the Singapore assets, they reported significant improvements in some of the occupancy rates and also the RevPAR. RevPAR in this case is the revenue per available room. And some of the key drivers that they've shared in their earnings would be pent-up travel, right? Not just for tourist arrivals that have been rising consecutively for 9 straight months in October. We've seen more tourists coming into Singapore, ourselves too, reaching the end of the year. Perhaps some of us are already planning some of the travels. So pent-up travel will, the pent-up travels of demand, we see that as continuing to grow, and that would be sort of one of the driver for this particular segment. And not to mention return of large-scale events. In September, we've seen F1, some of the big-scale conferences and events are also coming back into the market. So that would be some green shoots for the sector. Some highlights, for instance, Escort, they talked about their gross profit growing to around 90% of pre-COVID levels. Of course, some of this may be driven by new acquisitions, but I think they also shared, excluding acquisitions, the gross profit also grew to about 70% of pre-COVID levels. And they also continue to grow its stable income portfolio. That is the longer term stay master leases, that segment of their portfolio. For CDL Hospitality Trust, they've also reported that their RevPAR is now, in fact, exceeded pre-COVID levels, with Singapore and Australia growing the most that they've noted. Same thing for Far East and for Frasers Hospitality Trust. They noted portfolio improvements, the operating rates, hotel RevPAR, daily rates have also increased. Okay. And on the right, we took a look at the Singapore REITs with Singapore office assets. They've also reported stronger rental reversions and stronger portfolio occupancy rates. And something to note, which is the office rents in Singapore have been growing. And in fact, they have reached a near 14-year high. And this have exceeded the pre-pandemic peak. And in fact, taking a look at some of the CBD Grade A office rents, you would have noted that they took about 18 months to recover what they have lost somewhat due to COVID. Some of the highlights from these office REITs with Singapore properties, again, CICT, they've also noted stronger occupancy rates. Suntec REIT, in fact, they said that they've consecutively reported and recorded 17 quarters of positive rent reversions. Keppel REIT noted that their average signing rent has continued to rise, and OUE Commercial REIT has also noted in some of these rental reversions. So some of these green shoots that the office REITs are also observing. The next slide shows a bit of the highlights again, but for industrial and also for the retail REIT segment. For industrial, the occupancy rates they've noted resilient at around 95%. And the S-REITs that have noted in their earnings, right, they've mentioned that Singapore's industrial segment continues, or they believe the outlook over there continues to be resilient because of the longer term demand for logistics, some of these high value manufacturing and also biomedical sectors, and also some of the highlights, green shoots that are marked out by some of our REITs over here in their earnings. Same thing that we've seen in the retail space, perhaps something that we see better when we go to these shopping malls, right? You start to notice on the weekend crowds or even weekdays, crowds start to get thicker. Shopper traffic, shopper footprint has really increased quite a fair bit. And I don't know whether this is something that folks may also observe, but this is what our REITs have also reported, that the downtown malls have actually noted significant improvements. And in this case, downtown malls started to see, I think, double-digit growth in terms of shopper traffic and also the tenant sales, perhaps stemmed from the border relaxation and also more tourists coming into the Singapore market. And earlier this week on Monday, we saw the October extended retail sales continued to grow in October. And in fact, that was the 7th straight month of double-digit growth in that space. And we're approaching year-end season, which is festive period. Perhaps we'll look forward to having a look at some of these data points into first quarter next year. Okay, with that, that's a bit of a highlight on what has been happening in the REIT space, taking a look at what are some of the operating numbers that they've shared with us. This slide, I just wanted to leave with everybody, the SGX investor resources that we have. We have a Telegram chat that we put up regular market updates. For us from the SGX research team, we do have a regular REIT watch column on the BT, so look out for that. But if not, we'll probably pass the time over to Victor. Really, like I mentioned, right, First REIT was one of the best performing REITs for 2021. This year, they've also been pretty resilient in terms of their price performance, but their growth story is something to look out for. First REIT's 2.0 growth strategy, some of the acquisitions in Japan, and how are they growing that segment in a new market. So even myself, looking forward to hearing more from Victor. Thank you.
Thanks, Amelia, for a good roundup of the S-REIT. Up next, may I invite Victor to share his presentation? Over to you, Victor.
Thank you so much, Elaine. Yeah, thanks, Amelia, as well, for your kind introduction early on. Yeah, good evening, everyone. Really very glad that I'm able to, share more about First REIT, with all of you. Okay, maybe without further ado, let me just begin with my presentation. As what Elaine has covered early on, maybe I'll just give a very quick overview of First REIT. We are actually the first healthcare real estate investment trust to be listed in Singapore Stock Exchange way back in 2006. And our vision is actually to become Asia premier healthcare trust. Okay, as of current, we have about 1.2 billion asset under management that is spent across 3 countries. Okay, the bulk of it are still in Indonesia, 74% of them, which comprises 11 hospitals, 2 integrated hospital and more, and then 1 integrated hospital and hotel, and also 1 integrated hotel and country club. And then we have 14 nursing homes in Japan. These 14 nursing homes actually we acquire all of them this year, which I will touch on that maybe later in my slide. And then over at Singapore side, we have 3 nursing homes. All our leases are all very long dated, and the reason long dated is because of the nature of our asset. Currently, our assets are mainly hospital as well as nursing home, but our mandate actually is to invest and to acquire yield accretive healthcare as well as healthcare related asset. And this is not just confined to hospital and also nursing home. We actually cover a lot of other form of healthcare asset as well. For instance, assisted living, senior living community, or even other ancillary healthcare facility, medical office, medical building, specialized pharmaceutical warehouse or even storage facility, outpatient facility, life sciences innovation, or even research property. As long as there is a healthcare element, potentially these are within our mandate. Okay, so and every of our asset, there's only one single tenant. Hence, our leases are all very long dated, and most of our leases are all on master leases. Okay, so we have 100% of committed occupancy, and our weighted average lease expiry is around 12.7 year, and our gearing as of September this year is about 35.6%. So still way below the MAS statutory gearing of about 50%. So there is headroom for us to gear up, for acquisition purpose. Okay, and we also have a very strong and supportive sponsor in OUE as well as OUE Lippo Healthcare. As of current, in total, they owns about 44.1% of First REIT units, and there's a strong interest alignment, from our sponsor, with all the other stakeholders as well. Okay, next slide. Okay, maybe I will just spend a bit of time to cover our master lease structure. As I mentioned early on, all our leases are master lease to single tenant. Okay, and if you look at our Indonesia structure, base rent, and every year there will be an annual escalation of 4.5%, and there is also a performance based rent escalation. which is 8% of the hospital gross operating revenue in the preceding year. Okay, so we are comparing these two numbers, either base rent increased by 4.5% annually, or 8% of the hospital GOR, whichever is the higher number, we will take the higher number as our renter for that year. Okay, so that is the lease structure for the Indonesia property. And over at the Japan side, it's actually based on the fixed rent, and the renter may be adjusted upward every 2 to 3 years upon negotiation between based on the increase in the Japan consumer price index and interest rate. And then over at the Singapore side, again, it's base rent, but every year there will be an annual increase of about 2%. Okay, and then and all our leases are mainly triple net. Okay, what I mean by triple net is that the tenant or the operator will take care of the upkeep of the property, and they will also bear the property tax as well as pay for the insurance costs. Okay, so in Indonesia side, all our leases are triple net. Okay, and then in Japan, the cost of utility, mainly the upkeep of the asset, bear by the operator, and whereas the insurance costs and the property expenses are mainly taken care of by the trust. And then in Singapore side, there are 3 nursing homes there. 2 of them are on triple net, and there's actually 1 nursing home that is on double net lease. And that for the particular nursing home, we will be paying the property tax for them. Okay, so as you can see that our lease structure ensure that the impact of any rising cost or any rising inflation is being taken care of by the operator or the master lessee. Next slide. Okay, a quick highlight on our key financial for the 9 months of this year. Okay, we just reported our third quarter number about 2 months ago. Okay, and if you look at our rental and other income, as well as our net property and other income, it has gone up by around 40% to around 80.9 million for the rental income, and then our net property income is around 79.1 million. This was largely driven by 2 factors. Okay, of course, one of them is actually the contribution from 12 nursing homes that we have acquired in Japan in March this year, and then we have added another 2 more nursing homes in Japan in September this year. So in total, we have acquired 14 nursing homes in Japan for this year, and that has contributed to the higher rental and other income as well. And of course, I mentioned in my previous slide that every year for the Indonesia hospital, the rental will be up by a minimum of 4.5% annual escalation. In fact, I'm also glad to tell you that there are a couple of hospitals that we are beginning to enjoy the performance base rent, which is the 8% of the hospital gross operating revenue, which means that for some of these hospitals, the increase is more than the annual escalation of 4.5%. Okay, so as a result, our distributable amount also has gone up by 24% from 31.4 million to around 39 million for the 9 months this year. Hence, we are glad that we are able to give out a higher dividend for the 9 months of this year to 1.98 cents versus 1.95 cents for 2021. Okay, and our annualized DPU will be 2.64 for this year. This compared to 2.61 cents that we have given out for the whole of 2021. Okay, so there will be a slight increase of dividend for this year. Okay, a quick look at our new 2.0 growth strategy that Amelia just have highlighted just now. Okay, in fact, post the restructuring of our master lease arrangement, last year we've actually come out with this 2.0 growth strategy. And this is basically to prioritize the sustainability of our distribution to our unit holder. Okay, and within this growth strategy that we have come up with, there are a couple of pillars. Okay, for instance, number one, we want to be able to diversify into developed market. If you follow us in the past, you'll know that the bulk of our assets are mainly in the developing market, and that's Indonesia. Okay, and with this new strategy, we want to be able to diversify into developed market. And our target is that, within the next 3 to 5 years, 50% of our asset under management will be coming from developed market. And to this front, you will probably observe that this year we already acquire quite a number of nursing homes in Japan. As of now, 1/4 of our asset under management is already in developed market. So we are well on track to be able to achieve our goal of diversifying or increase our portfolio in the developed market to more than 50% of our AUM, maybe by 2027. Okay. And the second pillar for this growth strategy is that we also want to reshape our portfolio for better capital efficient growth. And on this, we want to be able to recycle capital from our non-core or non-healthcare asset or even mature asset. From my overview slide, you will understand that we have actually some non-core or non-healthcare asset. For instance, we have this hotel and country club that we are potentially looking at divesting it. Okay, and also another of our pillar in the growth strategy is that we also want to strengthen our capital structure to remain resilient. Even as we look to grow our portfolio, we definitely will need to diversify our funding sources so that we can continue to optimize our financial position going forward. And last but not least, we also want to continue to pivot to ride the later mega trend. For instance, the environmental, social, governance, aging population, demography, and also the under-penetrated healthcare sector. I will elaborate a little bit more on each of these growth strategy in my following slide. Okay, diversify into developed market. As I mentioned early on, we intend to focus our growth in the developed market, and our target is that 50% of our asset under management will be in this country, and we actually said it that by 2027, okay, more than 50% will be in the developed market. And as of now, more than 1/4 of our asset under management is already in the developed market, Japan and Singapore, following the acquisition of the nursing home in Japan this year. Okay, and due to this, geographical and tenant concentration risk will be greatly reduced. Okay, so this year in March, we actually have acquired 12 high-quality freehold nursing homes, which come from our sponsor, OUE Lippo Healthcare. And then a couple of months ago, we also have acquired 2 more high-quality freehold nursing homes, and these 2 nursing homes is actually coming from third party. So as of now, our AUM of 1.2 billion, 74% is in Indonesia, and the other 26% is already in the developed market in Japan as well as in Singapore. Next slide. Okay, all of these 14 property nursing homes that we have acquired in Japan, these are all operated by independent, well-established as well as experienced local nursing home operator. As you can see from this slide that we have 14 nursing homes in Japan currently. 7 of them are in Hokkaido, in Sapporo area. Okay, and the other 7 is actually in the main island in Japan, and also in another island. And if you look at the operator, currently we already have 5 quality operator that's operating our all 14 nursing home, and most of these operators are very experienced. As you can see that they have more than 8 years. In fact, only one has 8 years. The other one has more than 15 years, And the one that is operating in Sapporo even has more than 35 years of track record, and they are listed on the Sapporo Stock Exchange. Next slide. Okay, and this slide shows what we have done so far to reshape our portfolio for capital efficient growth. And basically, we want to be able to recycle our capital from non-core, non-healthcare, as well as the mature asset. So what we did this year is that we have actually divested one of our mature hospital in Surabaya, and this asset was acquired during IPO in 2006, and we bought it for around 16 million, and we are able to divest this hospital this year for around 40 million. So this is actually gross premium of over 143% over the original purchase consideration. So we are able to reap capital gain as well as opportunity to recycle mature asset which was constructed way back in 1970. So this is quite an old hospital, hence we see it as a good opportunity for us to be able to divest it to the operator. Okay, and another potential asset that we want to divest is actually our non-core asset. Again, this is also another asset that was acquired way back during IPO, and this is clearly not a core asset because this is a hotel and country club, and we already appoint marketing agent, to help us to procure a suitable buyer for this particular asset. Well, in the meantime, we will continue to lease this particular asset to the tenant for another year, so that it will provide revenue stability as well as give us flexibility for us to be able to divest this particular asset. Next slide. Okay, and as we look to execute our Growth 2.0 strategy, we are also looking at how we can strengthen our capital structure to remain resilient. Just sometime last month, towards the end of last month or early this month, we have actually announced that we have completed the early refinancing of more than half of our debt, and also to be able to mitigate the impact of rising interest rate as well. So if you can see from this chart on the left side, you'll see that one of the term loan that is due for refinancing in March 2023 is already completed the early refinancing last month, and we were able to move this to 2026. Okay, so with this announcement of this, or rather with this completion of the early refinancing in November this year, there's no more refinancing until 2025. Okay, and post the refinancing, our weighted average debt to maturity also has improved to 3.64 year, and our gearing ratio remains stable at 35.6%. And the proportion of debt that tied to delivering social impact was also have increased to 76.7% from 26.1%. What this means is that most of our debt, be it bond or be it loans, are actually social in nature. So this is also part of our effort, on the ESG front as well. Okay, and if you look at the chart on the right side, you'll see the proportion of debt that's on fixed versus floating. Okay, and post this refinancing as well as post this refinancing, we also have entered into some derivative interest rate swap as well as interest rate cap, to fix some of these interest rate. So as of current, 61.7% of our debt are on fixed rate. Okay, and there are another 20+% of our debt that is on a relatively stable rate, and these are mainly the bond or the loan that is in Japanese yen, that was borrowed in Japan. And as most of you will know, that Japan hasn't hiked their interest rate yet, so their interest rate environment is still very, very stable, and their rate are still very relatively low as of now. Next slide. Okay, and then one of the things that which I mentioned earlier is that we would want to continue to pivot to ride the latest mega trend, and one of them is to do our bit on the sustainability front, and to this we have entered into loan as well as bond that tie with the social element. So with the latest refinancing, the proportion of our social loan as well as bond has also increased to around 76.7% from the 26.1%. So most of our borrowing are linked to the social or the sustainability factor, and we want to be able to continue to contribute to the achievement of the United Nations Sustainable Development Goal. And to this front, we want to be able to achieve good health, good well-being that will be able to help us to meet this sustainable development goal. And we also want to be able to deliver social impact that's accordant with the social finance framework, that's aligned with international social bond principle, and also the social loan principle. And currently a couple of bonds they are tied with this social factor. And I shared earlier on that those bonds that are tied with social factor has actually gone up to around 76.7%. So 3/4 of our loan will be able to deliver a social impact that's accordant with the international social framework. Okay, this slide shows the positive outlook, for the healthcare industry. We remain optimistic about the social, or rather the healthcare sector that we are in. If you look at this slide, you'll see that the whole world is experiencing a high increase, in terms of our aging, more so in the developed country. You look at Japan, you look at Europe, you look at Singapore, US, and even Australia. The proportion of population that's age 65 years and above is going to rise quite significantly, from 2019 to 2030. Say for instance in Japan, by the time we hit 2030, 1/3 of the population will be about 65 years and above. Likewise in Europe and in Singapore and US, close to 1/4 or even 1/5 of the population is going to be 65 years and above. So there is a common trend of an expected increase in the number of people age 65 years and over in most of these developed countries. So we want to be able to take advantage of this factor, by investing in facility that tie in with this trend. Okay, and even you look at the global nursing care facility, study has shown that you expect to grow at a CAGR of about 4.8% to US $345 billion, in 2027. So the whole world is building more of the nursing care facility to cater to the increase in the aging population as well. Then even over at the developing country, in Indonesia side, we look at the hospital bed per 1,000 people there, and currently in Indonesia, they only have 1.04 hospital bed per 1,000 people, and this is way below the Asia Pacific average of around 4.5 hospital bed per 1,000 patients. Clearly, there is tremendous growth potential in Indonesia as well. So this is also a sector that's under served as well as under penetrated, and we also want to be able to look at how we can take advantage of this factor as well. Okay, this slide shows our total return, which outperform STS as well as the REIT index. Okay, post the restructuring in January 2021, we are able to deliver a total return of about 20.3%. This is actually average over 2 years. So each year we are able to deliver about maybe about 10%. So this is on par with what Amila has shared early on, 10% return. And actually, as of 30th of September this year, our annualized dividend yield is around 10.4%, and this is much higher than the S-REIT average return that was shared earlier, the 7+% that was shared early on. Okay, and if you look at our total return, we have managed to outperform STI, FTSE index, and we hope that we'll be able to continue to deliver the stable return going forward as well. Next slide. Okay, finally, I just wanted to conclude that we want to be able to strike a balance, with growth as well as stability. Okay, and with strong sponsor support as well as our new 2.0 growth strategy that is in motion, we remain committed to balancing growth and also stability in our portfolio so that we will be able to deliver sustainable distribution to our unit holder. Okay, so with this note, maybe I can now take questions.
Thank you, Victor. We'll now come to the Q&A session. May I now invite Benjamin Goh, Head of Research and Investor Education from SIAS, to moderate the questions. Participants, you may input your questions in the Q&A session here. And our Facebook Live audience, you can also click on the link and join us. We will try to answer as many questions as possible. Over to you, Benjamin and Victor.
Yeah. Okay, thank you very much, Eileen. Good evening, Victor. Always a pleasure to have you on our programming. Always nice to talk to First REIT. And you brought me back about a decade just now when you talked about thinking about offloading or diversifying away from the hotel, because there was the asset which I was thinking of, going down to Jakarta to getting out Indonesia to take a look when we first met about 10 years ago. So thanks for that walk down memory lane. We do have quite a few questions surrounding the growth strategy. So in your presentation, you've spoken quite a fair bit about the growth 2.0 strategy.
Yeah.
There are some pointed questions or pre-submitted questions regarding that. Perhaps could add a little bit of color as to how the growth 2.0 strategy might impact the outlook for First REIT in 2023.
Yeah, sure. Post the restructuring, we realized that I think the way for us to move forward and to grow is basically to be able to diversify into developed countries, so that going forward, our income, our distribution will be more sustainable as well as more stable. So with this in mind, we have made our maiden step into Japan. That's why this year we have actually bought. Of course, the first 12 assets actually come from our sponsor. And subsequently we are also able to add another 2 more assets from third party. And going forward, in fact, we hasn't stopped our acquisition in Japan. We are definitely looking at adding more healthcare asset, quality healthcare asset in Japan going forward as well. Yeah. And I also shared early on, I think one of our main growth strategies that we want to be able to diversify into developed market, and our target is that by 2027, 50% of our asset under management is going to be in this development market. And as of now, already a quarter of our asset under management is already in developed market, for instance, Japan and Singapore. So we will continue to look at more healthcare asset in Japan, in Singapore, as well as in other developed countries as well. Of course, our main priority now is to focus on Japan, and we hasn't forgot Singapore as well. So definitely we're also keeping our eyes on Singapore as well. Yeah.
Okay. But for people who are not so familiar with the sector, which also includes myself, why nursing homes in Japan? Why not hospitals? Because obviously that was the original or origin story for First REIT in Indonesia, a hospital. But why nursing homes?
Yeah, I mean, okay, when we go into Japan, right, we did look at hospital in Japan as well, but we also know that in Japan, most of the hospital are not for profit, Yeah, so it could be a bit challenging because although I'm not saying that we cannot acquire hospital in Japan, they're still possible, but I would say most of them, because it's not meant to make profit, so it may not make commercial sense, for them to sell it or to divest it into a third party. Yeah. Hence, we only look at nursing home in Japan, and also nursing home in Japan is more readily available in the sense that it provides very stable income for us, and it's not just us. I think if you look at one of our peers, they also have quite a number of nursing home in Japan as well. So it's proven that nursing home in Japan is an asset that will be able to deliver very stable return, to us.
Okay,
yeah.
and
I also shared
certainly,
early on that our mandate cover a lot of other things. It's not just hospital, not just nursing home. We can look at any form of healthcare asset, medical offices, medical building, living, aging life, senior living community, all form of healthcare asset we potentially could look at. Yeah.
I mean, I wouldn't mind looking into a assisted healthcare facility with a golf course. I'll call you up in about 30 years or so.
Yes, definitely. Yeah. I mean, if you look at some of the nursing homes that we have in Japan, I mean, they have very good facility as well. Yeah.
So the follow-on question for that is, it sounds like the diversification strategy, the Growth 2.0, right, is very much focused on Japan. But within the next 5 years, for example, with regards to your outlook and growth plans, do you also foresee diversifying into other developed markets?
Yes, it does. In fact, I think in our earlier presentation, we actually mentioned a couple of countries as well. We actually look at, and even you look at our slide earlier on, we actually talk about Europe, we talk about US, we also talk about Australia, and these are all developed markets, and these are all developed markets that we are looking at, and potentially can acquire asset from there. But with this rising interest rate environment, so it's a bit challenging for us to explore this market for now, but in Japan, they, as of now, they have not really hiked the interest rate, so it still make a lot more feasibility or more commercial sense for us to actually acquire asset over in Japan. This is the reason why our focus as of now is to look at Japan, but we hasn't forgotten the other developed market as well. Even Singapore is another country that we are also looking at.
Okay. So with regards to the Japanese business that you have, we do have a question about the currency risk. So the Japanese yen seems to be going lower and lower. This is obviously an outcome of their very loose or relatively loose monetary policy.
Yes.
Any impact on this on the cash flows or the profitability or the margins from the Japan businesses?
Yeah, it does. Post, we bought our first batch of the Japan nursing home way back in March. Of course, the time the exchange rate was much higher. Obviously post the acquisition, we have suffered a bit of forex. But as of now, only about 22% of our asset in Japan. So it's still not a big chunk, and then the big chunk is still in Indonesia. Of course, we also have added 2 more nursing home in Japan in September. Obviously, that new acquisition we managed to buy it cheap. So yes, the currency has depreciated a bit. As we continue to add more asset in Japan. So as of now, we will be able to buy this asset maybe a bit cheaper, but we all continue to monitor the currency movement, and then at the right time we will try to hedge some of this currency. But I mean, our view is that we talk to a lot of bankers. Is that I think that Japanese yen currently could be near the top already. So and then the view is that I think they will probably not depreciate any further, in the sense, hence but in any case, we will continue to monitor the currency movement and put in place any hedging mechanism at the right time.
Okay, and as you have mentioned, currency moves, especially with regards to the Japanese yen, is a two-edged sword, right? So cash flows coming out might not be worth as much as previously, but obviously capital expenditure into Japan will be relatively cheaper.
Yes.
So with that at the back of our mind, right, would you be able to give more color as to some of the assets that you might be thinking of acquiring in the next 2 to 3 years that might prove to be yield accretive?
Yeah, I mean, like I said earlier, we will be focusing. I think in the near term, we'll be focusing in Japan. So, like I shared earlier, we have not done with Japan yet. So we are looking at adding a couple more assets in Japan. Yeah, and then maybe as the interest rate environment in some of these developed countries stabilize, we also be exploring some quality healthcare asset there as well. Yeah.
Oh, okay, so it sounds like at least for the next 2 to 3 years, the focus will be very much on Japan, and in the longer term out, depending on the opportunities that might exist, First REIT might also start looking at Europe and US and so on and so forth.
I would say after Japan, maybe the next country will be Australia. Yeah, because these are countries that are not too far away from us, and then it's a lot easier for us to manage. Yeah.
Okay, all right, fair enough.
Yeah.
Okay, so in the interest of time, I'm gonna put aside some of the questions regarding the outlook, since we've had quite a few discussions about it. Gonna move to a different topic. So in terms of risk, what do you see are the major headwinds facing First REIT in the next 12 to 24 months?
I would say mainly is the interest rate as well as the currency risk. So on these two fronts, yeah, maybe I'll just tackle the interest rate. I think on this part, we actually have put in place some derivatives. We have entered into some derivatives. For instance, we have actually entered into interest rate swap, interest rate cap, to fix some of this interest rate. So as of now, around 62% of our debt are on fixed rate basis, and also and another 20+% of our debt are actually in Japanese yen. And I mentioned earlier on that Japanese yen, it hasn't really hiked the interest rate. So the rate are relatively stable as of now. Although we are also looking to put in place some hedges on this Japanese borrowing, notwithstanding that although they may not have planned to hike the interest rate, but we foresee that with the new governor that is coming in place first quarter of next year, this person may decided to hike the interest rate. So it's good for us to maybe have some Japanese borrowing going forward. So I would say that at least 80+90% of our debt will be on fixed basis, and on the currency exposure side, I would say, although the Indonesia rupiah has been relatively stable for the last 2 to 3 years, but lately we have been seeing a bit of softening, in the rupiah currency. So I mean, the good thing is that we have actually hedged part of the rupiah currency, maybe about a third of it. So we will continue to monitor the currency and put in place more hedging mechanism for our forex, including the Japanese yen that we mentioned earlier on.
Okay, but I guess as we all know, hedges can be a two-edged sword, right? Because
Yes.
it basically fixed or rather you're basically converting floating to fixed, and if the currency is supposed to move in your favor and you fixed it, then it's kind of like leaving money on the table. So good to know that you have a robust and flexible hedging policy. And again, I would assume that your finance team is busy looking at, or rather trying to read the tea leaves as to what might be happening in the FX, given the potential candidate for the new Japanese governor.
Yeah.
All right. Good. Okay, changing track here. We are now, the next question here is quite specifically about the net profit margin. So this came from one of our pre-submitted questions. So net profit margin has been decreasing by more than 10% a year for the past 60 months. And I'm not particularly sure whether the numbers are absolutely correct. Just reading off the question. Would you be able to provide some color as to why that is the case?
Net profit margin.
Yeah, decreasing by 10% a year over the past 5 years.
Yeah, I'm not sure about the net profit margin, but I would say that I think post the restructuring, we are also able to give a very, very stable dividend. And of course, I think one of the goals is that we will want to be able to give a very stable dividend going forward. I think that is what probably majority of our unit holder is looking at, that we will be able to deliver a very stable as well as sustainable dividend going forward as well.
Okay. There was a different question given First REIT's portfolio as well as its current debt load. How does First REIT manage its, I guess, its portfolio, in this kind of inflationary environment?
Yeah, I think one of the slides that I shared early on is that most of our leases are triple net, okay, which means that the tenant will take care of the most of the expenses. For instance, the daily upkeep of the asset, insurance costs, property costs, all these are all covered by the tenant. That's why if you look at our rental income as well as net property income, there's very little leakage, because most of the property expenses are all borne by the tenant, because of the master lease arrangement that we have entered into with them. So all this inflation about higher costs, it won't affect us that much because most of the costs are borne by the tenant. I think the only cost that we need to manage is basically the interest expenses, which to this point I shared early on that we have entered into some hedging mechanism to fix some of this rate, so that will not impact on our distribution in the near future. Yeah.
Okay. So just to add on, since we're on the topic of distribution, so there's a question here. So distributable income has increased by 38%, but distribution per unit has increased only by 1.2%. Would you be able to add some color as to why that is the case?
Yeah. Okay. One of the key factor, which I didn't really highlight in the slide, is that yes, I think our top line has actually gone up close to 40%. Okay, but half of the increase actually is due to accounting adjustment. So even if you take out the half the increase, our actual increase is still quite substantial, it's about 20%. Okay. That's why if you look at distributable income, even if you half it, it's still a very decent of about 12-13% increase. And our DPU is only up by 1% because we want to be able to give out very, very stable and sustainable dividend going forward. We don't want to, if this is something that we want to make sure that we will be able to deliver to our unit holder quarter by quarter.
Okay, so it sounds like the dividend policy is to ensure a stable and sustainable DPU rather than to, I suppose, overpromise in the short term.
That's right. Yeah.
Okay. All right. There is a question here specifically about the total return. So you have shown the slide where we had the total returns vis-a-vis the STI index since 2021. So the question here is that although since 2021, obviously there is a big outperformance in the total return of First REIT versus the benchmark. But over the last 6 months or 3 months, First REIT's total return has actually performed less favorably compared to the benchmark. Would you be able to explain that? And after you've done that, I will add a few comments as well.
Sorry, Ben, you're talking about what? The total return
in the last 3 to 6 months has not been as good as the STI index. Although over the course of 2021, 2022, it's outperformed, right? But in the last few months, it's actually didn't do that well. So, why is that?
I mean, this is not something that we can control, per se, But obviously, this doesn't just affect us. I mean, if we look at some of our, even our peer or even the greater S-REIT market, I think all are also being impacted by this as well. I think this is largely also due to the global macro factor, because the Fed is suddenly hiked the interest rate quite aggressively, to address their inflationary issue and things like that. So that also has kind of like impacted on us, and not just us, per se.
No, fair enough. So I'm putting your feet to the fire basically to get your inputs on that. All right. So now in again, just to kind of make sure we're all on the same page, let me just explain this a little bit. And this is not specifically for First REIT. So for all our friends out there, all the REITs have got this problem because the REITs are seen as very stable, akin to fixed income, but they are not fixed income. They're actually equity products. So if you look at the Singapore Savings Bond or Singapore government bonds, they are giving for about 4% interest risk-free. So, if you're looking at a dividend yield of a REIT about 6 to 7%, there's risk compared to 4% if you just buy a Singapore government bond. There could be a lot of investors that will then say, hey, I don't want to buy REITs anymore. I'll just go and buy Singapore government bond. So that has been happening. So there is more of a rotation between the different asset classes. And I would say that this is not specifically related to First REIT, but all REITs in Singapore has suffered that regardless of their DPU. So that's my take as the research for SIAS. Not that I am helping to answer for First REIT, but from a macro environment, sectorial perspective, that's what we have seen. And that's especially true for the last 3 months, simply because of the volatility in global markets, so on and so forth. So that trend accelerated in the last 3 months. So this underperformance for REITs, it's a large part of that is explained by the macro moves rather than any specific factors for First REIT, right? So I just wanted to give my inputs on that.
Yeah.
All right. Okay. Next question. All right. So back to Japan. So assets in Japan are mainly freehold nursing home. Freehold nursing homes. Is First REIT able to divest them easily in time to come?
I would say yes. I would say yes also because if you look at our peer, they also have recycled some of their nursing home, and so this is something that definitely we will also be exploring, but because we just entered into the Japan market, so obviously we are looking at adding more asset over there rather than to divest now, but But when we reach a certain size, potentially we can look at recycling some of our asset there as well, you know. Yeah.
Okay. And Japan is a bit of an odd property market, right? Because any foreigner can buy property. I mean, as an individual, right? You don't need any kind of special permit, right? Does
Yeah.
that apply to the commercial side of things as well?
Yes, it does. It does. It does. Yes. Yeah.
So anywhere here, just going to buy a commercial property. So little fast, like little people.
Yes and no, in the sense that yes, in the sense that I think Japan is a very open market. You know, obviously, you can actually acquire anything there, but I think you also need the local contact as well. You know, as you probably is aware that anything that they can't sell, probably they will offer to outsider outside the market but and of course the first buy is actually for people that has contact, people that know the market, yeah, I mean we part of the incentive for us to actually enter in market is that we also inherited a local team there, so we do have local contact. And if you look at our parents, they also have a lot of the Japanese joint venture partner and things like that. So we are also trying to leverage on our sponsor contact in Japan. Hence, we are also able to look at a lot of assets in Japan as well. So you need to have a good contact there, in a sense. Yeah.
Well, I mean, it's certainly very assuring that to know that First REIT has got this institutional capability.
Yeah.
Right. Always good to have a lobang, as they say in French.
It is.
Okay.
Yeah.
All right. By the way, it's not French for all you friends out there. Okay. Next, so there is a question about the debt load. So First REIT's debt is lower than below 35%, and there is more headroom to raise debt to buy more assets. So can you give us more details about the debt in which, or rather the currency of your debt, and how many percent or how much of that is in USD? I think you had a slide that actually showed that, but maybe it wasn't that clear.
Yeah, that's right. Okay, we don't have any debt in US dollar. Our debt are mainly in Sing dollar and also in Japanese yen. So as of now, about slightly more than 1/4 of our debt is actually in Japanese yen. Okay. Of course, the remaining are in Sing dollar. And currently our gearing is about 35%. So if we were to gear up to 40%, we have a headroom of around 100 million. Of course, if we were to be a bit more aggressive, we gear up to 45%, then we actually have 200 million war chest to help us in our acquisition. And we want to be able to take advantage of the lower interest rate in Japan. This is the reason why we are focusing on adding more assets in Japan.
That certainly makes sense. So the cheap financing, cheap yen, and graying population, I mean, all fits well into the nursing home.
Yeah, that's right. That's right. Yeah, and we already have a presence in Japan, so it's a lot easier for us to add on asset over there, and I mean, if you look at our recent acquisition in Japan, it's worth about 25, slightly more than 25 million Sing dollar. So it's still a bit of and we are able to fund entirely by debt. So and Japan asset, nursing home asset come in bite size, so it's a lot easier for us to actually add on to it, without raising too much debt, or without raising too much fund, in this juncture.
Okay. All right. So in the interest of time, it's right past 8 o'clock. I've got one more question, and this is kind of a roundup question. So some of the questions that we had, the pre-submitted questions that we had, kind of focus on a little bit of the, I would say, disappointment with retail investors out there over the last 12 to 24 months with regarding the price performance of First REIT. So, perhaps as a roundup, since we've talked a lot about your growth 2.0 strategy and your plans and so on and so forth, perhaps as a roundup, the last question will be, what has changed with First REIT?
Okay, I mean, post the restructuring, what has really changed is that I mean, a strong sponsor is very, very important. We have this new sponsor since 3 years ago, and they are really, really very supportive of us. In the sense, and there are a lot of interest, right, alignment in the sense that they now own quite a substantial stake in us. And they are very supportive of us. Even as we diversify into developed market, they are there to support us. Of course, the initial portfolio in Japan actually come from them. Since this particular acquisition, we are able to acquire more asset, and this will be mainly coming from third party. And going forward, I think in the meantime they will not have any of this pipeline for us to look at. So potentially going forward, we will be looking at asset that's truly coming from third party. But of course, with their strong support, we will be able to execute our growth strategy to diversify into developed market. And as we go into developed market, obviously, as we have more and more asset in this country, in this developed market, our risk profile will correspondingly reduce. And if you look at our current trading yield, why we are trading at such a high yield of 10% compared to our peers, probably trading at only maybe about 3% or slightly more than 3%, largely because of the risk profile, in the developing country. So if we are able to reduce our proportion in the developing country more to a developed country, we might be able to reduce our risk profile, hence narrow the trading yield, to a more reasonable or sustainable or acceptable level in the sense, and that would definitely help to benefit our unit holder going forward.
Okay, thank you very much for that, Victor. Always a pleasure to have you. And I would say that since I guess following First REIT for the last 10 years, and again that was way back then when all your assets were in Indonesia and you had only one master lessee, which was, by the way, the sponsor. So all that kind of things.
That's our ex-sponsor, a former sponsor.
Ex. Yeah, right. So like the ex-girlfriend, ex-sponsor. Certainly it sounds very interesting, the growth strategy and your diversification plans. And at least from my perspective, it sounds like a good bet. Japan, cheap yen, loose monetary policy, relatively speaking, growing population, so on and so forth, right? I think that's a good story to tell. And I would be, and then, I'm hoping that the friends out there that we have also might see that. There are many times when, companies do very well and, we follow them. But there are also times when there are companies which kind of overlooked in the market, which might prove to be quite resilient or interesting later on. This could be one of those times, but again, the caveat is, of course, that I'm not licensed by MAS. SIAS doesn't hold an MAS license, so take it as you will. So thank you very much, Victor.
No problem, man. It's always very delightful to talk to you. All this year. Yeah.
We'll catch up again next year.
Yeah, we definitely will catch up. I just want to thank all the audience from listening in. Maybe I just want to wish them an early Merry Christmas, as well as a wonderful holiday season going forward.
Thank you very much, Victor.
Yeah.
Okay, over to you, Eileen.
Thank you, Benjamin and Victor. I do have strong interest in Japan, but as a tourist. Yeah, okay, we have come to the last Corporate Connect session for 2022. And of course, on behalf of SIAS, we also like to wish everyone an early blessed Christmas and a bountiful new year. So without further ado, I think in case if you miss any part of today's session, you can rewatch the webinar on SIAS YouTube channel or on Facebook. And do visit our SIAS website to get updates on our upcoming investor education program. Thank you and enjoy the rest of the day. Bye.
Eileen, you're too young for the Japanese nursing home, I would say.
Yes, definitely. Yes, I'm looking forward to many more years.
Okay, thank you very much. Thanks,
All right.
Victor.
Thank you.
Thanks,
Thank you so much. Thank you. And bye-bye.